How to raise your credit score fast. What actually works? Your credit score can feel like a mysterious number handed down from nowhere, but it's actually built from a small, known set of factors, and a few of them can move faster than most people expect. In the next few minutes, we'll break down exactly what actually works, starting with the fastest lever available. At its core, a credit score is a summary of how reliably you've handled borrowed money over time. Do you pay on time? How much of your available credit are you using? And how long and varied is your track record? It's a snapshot of borrowing behavior, not a judgment of your worth or income. While exact scoring models vary, the same handful of broad categories tend to matter across most of them. Payment history, how much of your available credit you're using, the length of your credit history, the mix of credit types you have, and recent applications for new credit. Payment history and utilization together tend to carry the most weight. Payment history is the single most influential factor for most people. And it's straightforward: pay every bill on time, every time. A single late payment can linger on your report for years and drag the score down noticeably, which is exactly why automating at least the minimum on every account is worth doing immediately. If you're looking for the fastest realistic improvement, it's usually utilization, how much of your available credit you're currently using. Because this is recalculated regularly, paying down balances can move your score within a single billing cycle, faster than almost anything else on this list. One fast, often overlooked tactic: call your card issuer and ask for a credit limit increase without adding any new spending. If your limit goes up and your balance stays the same, your utilization ratio drops instantly, a free improvement that doesn't require paying anything down. Here's a timing nuance most people miss. Your utilization is typically calculated from your statement closing date, not your due date. Paying down a balance before that statement closes, rather than waiting until the due date, which is often weeks later, can report a lower utilization sooner. Length of credit history rewards accounts you've held for a long time, and it's calculated as an average across all your accounts. This is exactly why closing your oldest card, even one you rarely use, can quietly work against you. It shortens that average and can also raise your overall utilization. Credit mix rewards having a small variety of credit types: a card, a loan, and so on, rather than only one kind. This factor typically carries much less weight than payment history or utilization, so it's rarely worth opening an account you don't actually need purely to chase this one. New credit inquiries applying for several cards or loans in a short window can cause a temporary dip, since each hard inquiry has a small individual impact. Spacing applications out and only applying when you actually need the credit avoids stacking several small dips at once. One of the fastest, most overlooked wins: check your credit report for errors. An account that isn't yours, a payment marked late that wasn't, an outdated balance. You're entitled to review your reports for free, and disputing a genuine error can produce a real, sometimes fast, correction once it's resolved. It's worth being clear about what doesn't help. Carrying a balance month to month does not build credit any better than paying in full, and it costs you real interest in the meantime. We cover this and several other persistent myths fully in our Credit Score Myths video. Set realistic expectations. Utilization can move within one cycle. Error corrections can happen within weeks, but length of history simply takes time and can't be rushed. There's no legitimate shortcut for a factor that's fundamentally about years only: consistency, sustained over time. Build one simple monthly habit to protect all of this going forward. Check your score and report. Confirm utilization is staying low, and confirm every payment posted on time. A 10-minute check-in once a month catches problems early, long before they've had time to do real damage. Let's recap. Payment history and utilization matter most, and utilization is your fastest lever. Try a limit increase or paying down before your statement closes. Protect your oldest accounts and your length of history. Don't chase credit mix unnecessarily. Space out new applications. And check your report for errors regularly. If this helped, follow Liberty Wealth Insights for more financial education, made simple, in plain English, no jargon. We'll see you in the next one.